Hey everyone, John Henry here, Slingshot Futures Trading Group. Thanks for joining me in today's video. Before we start, take a second to give the video a like, subscribe to the channel, and make sure to click the notification bell icon so you don't miss our next live stream or next video launch here on YouTube every day. Make sure you start your day off the right way. Don't forget your free morning brief that's waiting for you at ssftg.com/brief. In the top left, you can click on morning brief to jump into that. That's where you'll find all of our major DP levels right up here at the top, as well as a quick technical overview for the major 6 markets that we look at: the NASDAQ, the S&P, you've got gold, crude oil, the euro, as well as Bitcoin. Maybe you're looking to get a full game plan for the day, week, or month. Check out the join button below. Level 1 subs get a brand new members only video every single morning going over the major 6 markets and a game plan for the day. In addition to that, once a week I launch a weekly brief, and of course once a month we have our monthly brief as well. Of course, all members gain access to our private Discord chat server, and if you really want to get into the nitty-gritty, check out the live analysis room for level 2 subs, where you can see my screens in real time during the New York Stock Exchange Open. You can ask questions and interact with the other members, as well as bounce ideas off myself and everyone else. It's a fantastic environment, and I would love to see you in there. All right, and now on to the really fun stuff, the topic for today. The reason trades fail. I had a comment a few days ago talking about how useful it would be to cover why a trade fails. And I 100% agree, and I love the idea. So thank you, Full True, for the suggestion. The comment should be on the screen there. So let's break this down. Why do trades fail? That's kind of the ultimate question, I suppose. Really, it comes down to 3 main reasons why a trade can fail. The first reason is a technical failure, right? So if we're looking at it categorically from top down, the first reason, it can be a lot bigger than that. Let's make this little, well, that might have been extreme, but sure, let's go with that. Okay, that's not going to work. Whatever. So the number 1 is a technical failure. And number 2 is a psychological failure. And then number 3 is a risk-reward versus probability failure. So let's start with the first, the technical failure. Now, a technical failure is when you have a trade set up that just didn't work. Right? It was the other probability to your trade, the yang to your yin. It wasn't fun, but it's part of the game, and we just have to accept that it's going to happen, and it's totally normal, and it's just part of business. A technical failure would imply that you followed your plan perfectly, right? You executed exactly where you were supposed to execute. You did exactly what you were supposed to do at exactly the right place. You managed the trade exactly the way that you were supposed to, and it just didn't work. Welcome to the trading world, right? You didn't make any mistakes, nothing went wrong, it was just the other end of the probability, and the only thing that actually failed was the trade itself. These are, hopefully at least, the most common and acceptable of failures that you're going to run into. Then secondly, we have psychological failures. These ones are tough because it's a failure due to you, the trader, making a mistake, going against the trade plan, failing to execute properly, or managing the trade correctly or totally incorrectly. This usually occurs due to an emotional connection to the trade. Maybe you're trading with too much risk, $1,000 account and you're trading $100 at a clip. That can be very emotionally taxing. It's hard to manage that because every trade you take is almost jumping off of a building every time with the account. Or, maybe you're trading purely off emotions, like feeling the pressure to have to make money to pay the bills, or a loved one putting a bunch of pressure on your shoulders to make money to pay the bills. Maybe you just slip like crap. Maybe you just had a fight with your SO. Regardless of the reason, something is causing you to make really bad trading decisions outside of your plan. These are super dangerous because you can get into some deep trouble really fast trading on emotions. These are the types of mistakes that can ruin accounts and blow up careers if you aren't careful. So when trading, you absolutely must keep watch for these types of errors. You will have them. Everybody will. But recognizing it is the important part and could be the difference between having an account and not. So when you realize you're making psychological mistakes, it's time to call it a day. Wrap up shop. Stop trading. The risk is too high. Hopefully, these are few and far between, but they will be more frequent for newer traders or less experienced traders who still haven't gotten the feel or the psychological grip on how the markets operate. And then there is the third one, which is a risk-reward versus probability failure. These are a bit harder to stomach sometimes because they can still be winning trades, but be failures in the eyes of your trade plan. This is when you have a great-looking setup that has a non-favorable trade math. This means that your probability of success on the setup doesn't line up profitably with your risk-reward. The reason these are considered failures is pretty simple. Even if it was a winner today, a winner this time, etc., trading this way is going to blow your account up. You're absolutely going to run into some issues with this because you have to ensure your trading math is favorable on every single setup. That means that if you're entering in a trading location that's about a 50-50 probability of success, then you better be utilizing a strategy that's better than 50-50 in that area to make sure that your math is solid. Now, here are some examples to look at when we're talking about trading math. So scenario 1, let's try this again. Let's try this again, maybe just a touch smaller. Yeah? So scenario number 1 is you have an 80% accurate trader. And within that 80% accurate, the average loss is about $100 and the average win is about $50. That's scenario number 1. Scenario number 2. Scenario number 2, we have a 40% accurate trader, but within that 40%, our average loss is $50 and our average win is $100. And then we have scenario 3. And scenario 3 is an 80% accurate trader. Again, very high. We have a $50 loss. Whoops. Let's do that the right way around. $50 average loss and an average win of $15. Now, when we're looking at these different things, we have to kind of figure out the math on each one. So making math easy, right? Let's just assume 100 trades or 1,000 trades or something indivisible easily by those numbers. So we can go through these and we can make this math really, really straightforward. So let's grab a calculator really quick. And the first one was an 80% accurate trader, right? So 80% of the time they make $50. So 80% of the time, they make $50. And then the other 20% of the time that they're wrong, they lose $100. Now, including some factor of commissions inside of here, we can also factor maybe an extra between all of them because it's 100 trades. You figure buffer it by maybe 20%. But either way, we have 2,000 and 4,000. Well, if I take the winners minus the losers, I have a positive 2,000. That is a positive math expectancy, which is good. That is a positive thing. For scenario 1, that means that 80% accurate trade, even though they lose $100 when they do lose and they only win 50, favorably, mathematically at least, it's still a great strategy to approach the market with. So let's look at scenario 2 then. What does scenario 2 look like? Scenario 2 is a 40% accurate trader. So 40% of the time, they're making $100. That means that they're wrong 60% of the time. But those 60% of the time, 60% of the times, but whatever, times 50, they lose $50. That's 3,000. So if we take the winners minus the losses, we have a positive expectancy of 1,000. Now, it's not as good as the last one that we were just looking at, funnily enough, but this is a scenario where it's still mathematically favorable. If you factor commission into this, though, it becomes a little bit less good, right? If you're taking away another 20% on top of that, it's only a positive 800. Whereas the last one, right, we had a positive 2,000. Even if you take the 20% away, you're still at 1,600. It's a really nice positive expectancy. So this one is still positive. It's just not as good. And then you have the final one, which is the 80% accurate trader, where when they win, they make 15 bucks. When they lose, which is 20% of the time, they lose 50. That sounds like it really stings, doesn't it? Now let's look at the math. 1,200 minus 1,000 is still favorable mathematically. But remember, this is where you really have to think about how the market operates. We don't trade for free. It costs money when we push the button. There's a thing called commissions, unfortunately. And because of that, well, we have to understand that this scenario isn't good. If we take 20% off of 1,000, that's 200. That leaves us with nothing. It's zero. This is not a favorable scenario. This is a break-even strategy at best. And if you flub anything on it, if you trade it imperfectly at all, then it's immediately into a losing scenario, and the trading math is terrible. So really important to make sure that you're keeping an eye on your trading math on every single scenario that's coming up. So in every scenario, don't forget to assume some costs for commissions, because that does play a really big role. You know, trading a 50-50 with a 1-to-1 sounds fine, but with commissions factored in, you're going to lose money. The higher the trade math number, the better off you are. You want that thing to be way up in the sky. So before you plan out your next trade, don't forget to plan out your trade math. You may just realize that the trade that you thought was a sure bet may just be a trap in disguise. Thanks for watching, and like we always say, stay safe out there, keep those stops in play, and let the winners run. Have a great rest of your day. Thanks.